Okay, so my name's Randall Wall. I've been in real estate quite a while. I've been doing business in Utah, Idaho, Oregon, Washington, a little bit in the Illinois, Missouri area over the years, and I'm still letting people in here. So my idea here is to run this like a fire hose. I'm going to just put a lot of information out there. Hopefully, you'll get one or two things, and it'll be useful to you. I'm going to cover what's happening in the macro. Then we'll take a look at the Utah economy, and we'll also move into what the future looks like and where the opportunity is. So, if you see me a little distracted here, it looks like I've got a few people that are checking in here. Quickly. So I'll be looking back and forth and letting people in. I'm going to share my screen with you. And all right, so we should be seeing, today's economy, the big picture, because that is truly where we're at. And let me make sure I've got, okay, let me pull this over here. And so I can see everybody there. All right. And okay, so a lot of people, will say, Randall, what's going to happen in the economy? And the one thing, they'll quote to me is something NAR says. I have no faith in NAR. I think that problem is going to take care of itself this year with all the issues they have. They've never been good at predicting anything. And anybody that tells you that the real estate market is dependent upon mortgage prices is a moron, or mortgage rates is a moron. Okay. That's a one-trick pony. And what I mean by that is mortgage rates can be important, but they're not all important. So I'm going to run through some data here and see if I can, if you disagree with me, I'll see if I can change some of your minds on this. And let's take a look. So up on the screen, nod your head if you can see the screen that says today's economy, the big picture. Okay, awesome. All right, so we're going to explain a little bit about money supply. And like I said, I'm running through this like a racehorse. So M1 and M2 money supply explained. So M1 money supply is the estimate of the cash, checking, savings account deposits that you have, whatever you've got to spend. M2 is M1 plus the money supply that includes all of the cash that we have on hand, plus money deposited in CDs, savings account, other short-term accounts, etc., retirement accounts that are over, our retirement accounts are not counted, and accounts over 100,000 aren't counted. So it's basically what you could lay your hands on as far as money is concerned quickly. All right. Well, M2 money supply can be used as a determinant of what's happening in the market. So okay. All right. And okay, let's put more in here. So when we look at the market, the U.S. money supply hasn't done this since 1933. So almost 100 years, right in the heart of the Great Depression. The M2 drops of at least 2% have been telltale signs of an economic downturn, and they have never failed. Okay, every time you've had a 2%, you had a recession, and it was a hard one. We're dropped almost 4% now, so it's double what's normal. As you can see here in the 70s, I starts off on the 60s to the left of the screen, or at least it's the left of my screen, and it's a flat line, right, with a couple little blips here and there. And you can see what we've had as far as recessions during those time periods. Then it falls off a cliff here in 24. So that's where we're at. Also, when it comes to money, the U.S. Commercial banks have had a dip as well. So if we look at the top here, there's been a lot of times that there's been little drops along that period from the 70s forward of less than a 1.5%. There's only been 3 times in 51 years where commercial bank credit fell by more than 2% from its all-time high. Okay, and so we're starting to see a drop. It has been down. It's over 2% right now. So I would guess from those alone, if we figure there's only 3 times that it's happened, that's a good indicator as well. So what this means when you have a drop in commercial credit is that the financial institutions have tightened their lending standards, And that means that capital is getting restricted. So some of you are noticing that it's a little bit harder to get loans. It's hard to get loans on commercial property. And so it's kind of like pushing the brake, right, on a fast moving vehicle, and it slows down corporate earnings, et cetera, or it can potentially shift it into reverse. And we're seeing companies, big companies, lay off tens and hundreds of thousands of people, which is what happens when you see a drop in the M2 money supply, as well as the corporate lending. So the previous two instances when commercial bank credit fell by at least 2% coincided with the benchmark S&P 500 losing about half of its value. So that will be interesting to see what happens there. One thing that you need to realize is that 80% of all US dollars in existence have been printed in just the last 2 years. I'd say maybe the last 3 years, but this person said the last 2 years. And so I'd say last 3 years because it's January, 20th, 22, they said that. So we'll say last 4 years. That's still huge. What happens when you print money and you have a limited supply of goods? Costs go up, inflation takes over. US inflation means that families, are paying a lot right now. I can remember getting I'm a vegetarian, so I get those Impossible burgers. I'm sure they're not good for me, but they taste delicious. And I used to get those at, $4 or whatever. And I was going through Klamath Falls and, here the other day, and it was close to 10. So they've gone up. The average family earns $75,000 a year. Moody's, CNN, everybody else says that the average family, this was last year, as of August, was spending $709 more per year for their living expenses, with no new expenditures on cars, housing, or any big ticket items, just the usual stuff. So if the average family earns $75,000 a year and the average wage increase is 4%, that means they make an extra $250 a month. So we're seeing a net loss of about $500 a month. We saw inflation from 22 to 23, which was reflected here. We've also seen inflation from August to present. So when we look at inflation here quickly, we can see that juices and drinks are up 29%. Uncooked beef steaks up 11%, baby formula 9%. I'm just rounding here. Sugar 7%. All of these things have gone up quite a bit. Anybody who's gone out to eat knows it's expensive. I remember Justin Udy told me that he says, it was funny. I went to just some cheap little Chinese restaurant. There was 3 of us, and it was almost $100. All the other items that you can see here, electricity, 4%. Motor vehicle insurance, this was interesting, up 21%. Repair of household items, 18%. Admission to sporting events, 13%. Tax returns, 11%, et cetera. But this is a lot more than what the government's claiming of 3%. Shadow Stats runs different numbers and says that real inflation has probably been around 11% for the last few years. So everything's gotten more expensive. Also, it's harder to get some things. I bought a electrical panel for it was a 7-gang unit for a multi-unit that we're doing. It was $4,000. In 2022, it was $400. So it was hard to get. I was lucky to get it. It took me 3 months. So the cost of living, they say, is increases prompt a 3% rise in heart attacks, and young adults are delaying life milestones. The total US savings amount is the lowest in recorded history. And that's actually happened pretty quick because I spend at least an hour a day minimum on looking at the US economy and all of the outlying data points, because it's like being on the beach. And when you're at the beach, especially if you're in Oregon, where I grew up in the Northwest, there's not a lot of sunny days, and you can see the storms coming in. Okay. The storms are always coming in from off in the distance. And the same thing happens in economies. It happens in real estate. You can see the clouds in the distance, and it moves from the outside inwards. Okay. And so when I say that somebody who says that mortgage interest rates, drive the real estate market, morons. All right. If you don't have money, you're not spending money, no matter what the interest rates are. The interest rates dropped at 1.25% here last month, and mortgage applications dropped by 12% over the same period. So there's something more than just interest rates. Well, the personal savings were at an all-time high during COVID because of free government money, et cetera. Well, here just a few short years later, you know, I pulled up from 2010 just to show what was interesting was that then they said it was the lowest. Then it climbed. By 2021, it was the highest in history. And again, we're seeing the lowest personal savings rate in history. So credit card debt is up 16% year over year. This is just kind of a snapshot of what the average home looks like in the US economy. But credit card debt's on average 20,000, okay, for a home. So it's up 16%. 12% of credit card debt is delinquent, okay? 12% of credit card debt is between 60 and 90 days late. That means that 1 out of every 8 people is behind on their credit card payments. People pay their homes before they pay their credit cards. Credit card delinquencies surged more than 50% in 23 as a total of consumer debt swelling to 17.5 trillion. The Fed said inflation was higher than expected. We can see that. You don't expect the Fed to do anything with the interest rates because inflation hasn't been tamed. The consumer confidence index was lower than they expected. The inflation did worse than they expected, et cetera. I would be very cautious if you're planning on the Fed's doing anything. And when I looked at the interest rates, we're back up close to 7% for home loans. This is the Mortgage Bankers Weekly Mortgage Application Survey that I pulled up here this week. And the applications was lower, 19% lower than the same time or same week a year ago. When you look at mortgage applications, you can see what it looks like, from back, goes back to 1988. And you can kind of see the median line here. Well, we're actually hitting the median line where we were at back in 1995. Okay, so there's a difference. It's not just inventory. Inventory is important because that's what is keeping the prices somewhat in line, is because people don't want to give up those 3% loans. If there was more inventory on the market, we would see a massive drop in prices. Okay, what's keeping the prices where they're at is the fact that the inventory has been limited. People don't want to give up 3% interest rates. And you can look at the 130-year average. We're way above when it comes to cost, when it comes to national prices and that home price index over the last 130 years. We're way up here. This is a massive peak. There's got to be a correction. Something's got to happen. So two things happen. Typically, what happens is home prices drop. We see a recession, or all of our earnings would have to go way up to meet those home prices. And so I'll let you decide what you think is more likely to happen. If we look at ReVenture Consulting did this, and they were pretty data heavy. I like them. A lot of the data I get comes from them or from corollary sources that they use. But this was pulled up 2 days ago, and it said only 11% were more likely to buy now. 14% said they were less likely to buy. But here's what was really significant. 75% of home buyers say it doesn't make a difference. Prices are still too high. So this is reflected in the credit card debt, in having no savings. They've already spent their savings. They're borrowing to cover their living expenses. And when the average Joe is $500 a month upside down compared to a year ago, even after a raise, that's a problem. I had lunch with a small, and I think they're only in Davis County, a small car dealership with their CPA, and he said that they had repossessed 500 cars in 2023. So you can see where it's trickling down. Green Street says that apartments have lost 30% nationally, okay, in value. It's been 80% on the East Coast, and it's dropped, in different areas. It goes up and down because real estate is local, but it starts off on different places like clouds on the horizon, and then it moves inwards to where you're at. It's been my experience. If you look at the different sector losses, over the recent peak was June of 2022. We see all properties down 22%. That's what they're saying. The apartments are down 30%. Industrials down 16%. Malls are down 20%. Offices are down 35%. Our corporate office is probably half filled right now. The one across from us is empty, and they're trying to sell it for $12 million. Probably not going to happen. If you're like us, most companies sent their people home and people are working from home. I do not see a return of office space as being good business for maybe forever. It's just not going to happen. We tracked our payroll team that had 21 people, and the 21 people went home. And according to our CEO, the productivity didn't drop. So I'm sure that everybody else found that as well. But you can see some of the data in there that's kind of interesting. So the commercial property price index down 22% overall, the lowest since 2015. Now, where this gets real and interesting is we see that New York Community Bank Corp shares have dropped by 60%, here recently. This is interesting. You're like, oh, who cares? I've never heard of New York Community Bank, right? Well, they're actually the 34th largest bank in America. In fact, they're bigger than Deutsche Bank, Raymond James, Webster Bank, et cetera. It's not a small bank. They have massive losses in commercial real estate. Now, if you remember SVB Bank and some of these other banks, there's 147 of them on the watch list. US Bank's one of them, Zions, there's a whole bunch of them. They invested in bonds, and their bonds were crap because the newer bonds, the short-term bonds, interest rates went up, the long-term bonds went down. You can get a higher interest on a 90-day CD than you can on a 10-year CD. That's called a bond yield spread inversion. Well, if you look at what happened with this bank, this New York bank, they're down 264% in earnings, which is why their price went down 60%. Their provision for credit losses in their commercial market a year ago was 124 billion. It's 552 for this year. Okay, that's the projected provision for credit losses, which is up 790% as far as the projection in the last 5 months from September, and it's up 345% from December 31st of 2022. Banks are holding $3 trillion in commercial real estate loans, which is up 50% from 2015. Small banks are teetering, expect more failures. This is Barron's. There's a systemic risk of large-scale bank failures in the US in 2024 due to charge-offs and write-downs emanating from the commercial real estate sector. And it's not just small banks. It's the huge banks as well. We've got the FDIC insurance is all but meaningless. I talked to my dad here last week, and he says, I said, Dad, I'd pull some cash up, maybe buy some gold, put it in, some property you got paid off, etc. He's like, oh, it's all in FDIC insured banks. That's just a feel good. The FDIC has reserves of $100 billion. If you remember Silicon Valley Bank, their deposits that had to be covered were $209 billion. So the FDIC, the entire FDIC, which is supposed to cover all the banks in America, would only cover half of the losses of SVB Bank. So what they did is they work out. What typically happens is the government will step in, and if they bail out a company or bail out a bank, that creates inflation because it's more money in the market. I had friends that had money here. It took them a couple of months to get their money back, but they did get their money back. But they convinced Credit Suisse to, the government sweetened the deal for Credit Suisse, put some money there, got them to buy SVB Bank and take them over. When you see this kind of thing happening, Citigroup, bank regulators have gotten on these guys twice. They're concerned now because they're saying that they need to take urgent action to fix their resolution plan. Well, the resolution plan is what to do in case of bankruptcy. Okay. If you look at Citibank, it is the third largest bank in America, the 11th largest bank worldwide. And they are struggling, and they're in fact they got bailed out once when their shares were selling at $500 a share. It went to under $1 at one time. The government bailed them out, and they're still struggling. So 2023 is already the worst year for bank failures in U.S. history, measured by deposits held by failing banks, because there's a lot of money held by those banks. So that's something to look at and just be aware of. When the credit supply, the money supply shortens, people stop buying things. Okay, so UPS just announced 12,000 job cuts. UPS has never dropped jobs that I'm aware of. I worked for them for more than 10 years. They're the largest shipper, the largest internal shipper in America. That says that there's some issues when it comes to sales for other companies. Maersk is cutting 10,000 jobs, and they're one of the largest shipping firms, and so on and so forth. So there's a lot of stuff there. So let's talk about where the opportunity is, because we're coming up here. I wanted to make this really quick, and let's admit that person. Okay, so there is some opportunity. Seller financing is up over 1,000%, according to a number of title companies that I've talked to. I would jump on that and take advantage of 3 and 4% interest rates. FHA and VA assumptions, there's more and more people doing those. I am the largest brokerage in Utah, and we can see what comes across our desks. And we're seeing a number of FHA and VA assumptions. Those take a while. But again, people are looking for 4%, 3%, 2%. Nick Welland, he just did one at 2% for one of his clients. It was a VA assumption. So it's nice. Here's a data point for you. FHA loans are 16% of the entire mortgage market in America. 10% are in default today. Okay, so that's up. Bank REO, I would say get a relationship now, because there'll probably be more properties coming on the market. We're seeing foreclosures tick upwards a little bit, but I think we're only in the very beginning of this. I just listened to Harry Dent. He feels like it's the same thing. He came out 2 days ago and said, I think we're in the very beginning of what we're going to see as far as a downturn. But now is the time to get a relationship with banks and lenders or small credit unions, et cetera. Foreclosures, again, if 10% of the FHA loans are in default, there's opportunity there. That foreclosures might look different this time. People just say, oh, we'll just do short sales like we did last time. I've been in the market since. I did my first slip when I was 15. I did it a week before I turned 16 with a friend of mine who was an investor, Larry Nilsson, amazing guy. When I look at my history from then till now, it's never been the same. So every downturn's always been different with different opportunities. So in commercial, I'd look for seller carry as banks tighten their criteria. There's going to be a lot more seller carry. We're starting to see some of that. I'd look at credit card defaults as a starting point for motivated sellers, because the numbers are all over the place. But the one thing they all agree on is that there's a lot of people in default. It's been said that what was it? 60% of people are earning 200,000 a year, living paycheck to paycheck. 68% of those earning 120 or less are paycheck to paycheck. That's Dave Ramsey and his daughters, for those of you that listen to him. So I would start looking at some of those lists. If you're looking for a marketing list, you can look at credit card defaults, because people are going to pay their houses before they pay their credit cards. They're going to make their house payments. And so as an agent, as an investor, I pull up a list. You can get a list from Equifax, Transperian, or you can get one from a list broker, and you can put in there, okay, they have a mortgage and they're 60 days late, 30 days late, 90 days late on credit card debt. It'll spit out a list. Those are people that I would think would be potentially open to selling their house. You can pick up distressed property as the market over the next year, pick up when units are reduced due to bank issues. Because what typically happens is And if you look at that YouTube one, I'm recording this. I'll give it to Dominique that they can share with the club. But there's usually, there's build, build, build. Everybody's building all these units because inventory is low. Inventory is really not low. Affordable inventory is low. Okay, there's no problem with inventory. The problem is affordable housing. We don't have enough affordable housing. But what happens is people build, 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 build. Okay, and then the market, gets soft. Builders go bankrupt. Whatever happens, happens, and then it gets soft. The guys that are smart pick up property at a discount because all of a sudden you got a housing shortage. And then you make a ton of money because you've got this housing shortage and you watch the market climb. That actually happened in 07, 08, onwards. I look at some of the properties we bought and, doubled, tripled, quadrupled in price. There's opportunity there. So let's look here really quickly. We're almost at the hour, 2 minutes, but let me do this. And I want to show, I'm going to show you an app that I use. It's this ReVenture app, and you can pull a lot of data in there. And there's a lot of scores where you can pull like a home price forecast. So if I look at this here, I can say Salt Lake County. If it's below 50, it means that market is going to come down over the next year. Okay, that market is probably going to decrease. It's a great, better than even chance. And it's based off of momentum of values due to data points like appreciation, inventory, price cuts, days on market, home affordability factor, et cetera. And so you can pull other data here, home value growth, year over year actually wasn't so bad. Let me get back in okay, come on back here. Okay, and let me log in here. A lot of areas went up by, 1% here in Salt Lake County. And this is about, I think this is $39 a month. So here's Salt Lake City. If I'm looking at, this growth here at 0.2%. Okay, it pulled up 0.2%. In there, they're saying that the value went up. If you want to look at overvalued, you can look at the overvalued percent. Utah is still in some of the most overvalued areas in the country. 26% in Salt Lake County. Down here, it's 22% in Utah County. Utah County is actually improving. It was 34% like 2 months ago. And you can see Davis is 29%, Morgan 28%, Weber 37.4%, et cetera. And so it'll tell you that. You can look at house payments as a percentage of income. This is where, okay, and I don't know what's going on with my screen there. Let's do Sandy. So I can pull here and I can pull each one up by zip code. So here's 84090. So as a percentage of income, it tells you it's 38%. It's 45% in 84070. If we look at the buy versus rent differential, this is what has to do with, mortgage interest rates. Great. If they come down, more people can buy. But you've got to overcome this issue right here, which is it's 80% cheaper to rent in Sandy than it is to buy. Okay. If we look out here, it's 65% in West Jordan. It's Taylorsville's, it's saying is 99%. So Taylorsville's expensive. It's 70% cheaper to rent in West Valley. And there's about 40 or 50 different data points here. You can find your market demographic, median household. You can break it down by zip. I do that. We can look at all the different investor matrix, cap rates, rents, percentage of income, shadow inventory, rent growth year over year, et cetera. And so there is opportunity. There's always opportunity, but we need to look for it and we need to realize it. And what's available. And I would be making sure that you're saving some money. Things don't look pretty from the economic standpoint. I am hoping that we don't see a run on the banks like we saw in It's a Wonderful Life. And I would think that the government would step forward, but understanding again, it'd be good to have some cash, enough cash to go for a month or two, just in case. Steve Thorpe's a good friend of mine. He had money in SVB Bank. It was 2 months before he could get his money out of there. The government only had enough money to cover half of the losses of SVB Bank. So $209 billion in losses. The entire FDIC, their entire fund is only $100 billion, so less than half of those losses. If you see Citibank is, having problems, it's teetering. New York Bank, 34th largest bank in America, it's in trouble. There's a lot of banks are in trouble because they invested in commercial real estate. And on average, commercial real estate's down 22%. Multi-units are down 30% nationwide. There's a lot of issues there that